Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're doing what we do best, unpacking an earnings call.
That's right.
This deep dive is all about the second quarter 2025 earnings results. And what makes this quarter particularly fascinating, I think, is how it unfolded in two distinct halves.
Yeah.
We started with some, early uncertainty, market jitters linked to U.S. trade policy, and then saw a really strong rebound, fueled by increasing engagement in the latter half.
It's a prime example, really, of how a firm can navigate these wildly different market backdrops, but with a consistent, clear strategy.
Right.
So we're going to pull apart the key numbers here, but maybe more importantly, we'll try and extract those strategic insights that truly explain why these results matter, give you a comprehensive understanding of where this firm stands and where it's truly headed.
Okay, let's unpack this then with the immediate snapshot of their performance. For the second quarter, the firm delivered a robust $16.8 billion in revenue. Earnings per share came in at $2.13. They also reported an 18.2% return on tangible equity, which is a pretty solid figure.
And when you zoom out a bit, this quarter capped off a very strong first half of 2025. Brings them to $34.5 billion in revenue and 4.73 cents in EPS.
Wow.
Alongside an even higher 20.6% return on tangible equity year to date.
Okay.
What's truly impressive here, I think, is that this marks 6 sequential quarters of durable earnings.
6 quarters.
Yeah, that's a powerful signal that their performance isn't just, a fluke of market conditions. It's a result of something more structural, something more consistent.
That consistency certainly stands out. Now, management highlighted a strong focus on generating returns from incremental capital deployment and investing for growth, especially with the expectation of a more, let's say, constructive regulatory backdrop. So what does this actually mean for their financial flexibility, their capital structure?
Yeah, that's a critical question. The firm's CET1 ratio, that's Common Equity Tier 1, a key measure of a bank's core financial strength, how well capitalized they are.
Right, the buffer.
Exactly, the buffer. It stands at a very healthy 15%.
Okay.
This means they have over 200 basis points, or 2 full percentage points, of capital above their forward capital requirement. Think of it like a substantial financial cushion. Gives them significant ongoing flexibility to manage the business, withstand shocks, and, importantly, pursue growth. It allows them to increase their quarterly dividend to $1 per share.
$1, okay.
And maintain a $4 billion annual pace for those opportunistic stock buybacks, returning capital directly to shareholders.
That capital position really gives them a lot of wiggle room.
Yeah.
So where are they actually looking to put that substantial capital to work? Is it all about acquisitions, or is there something else going on?
Well, it's not just about acquisitions. I mean, they are evaluating inorganic opportunities, but they said the bar for those is set incredibly high.
Right.
It needs clear strategic alignment. Their primary strategy really emphasizes supporting their existing clients and growing those core businesses. We're seeing them specifically deepen their footprint with corporate clients through additional credit extension, particularly in areas like investment banking and wealth management.
Okay.
They're also leaning into more durable financing businesses like prime brokerage that supports the big institutional trading clients and secured lending. And they expect areas like M&A and underwriting to pick up significantly, which would provide that additional operating leverage, more profit for each dollar of revenue.
Fascinating. So they're strategically extending credit where it really makes sense rather than just broadly. Let's shift our focus then to wealth and investment management. Total client assets have climbed to over $8.2 trillion.
Huge number.
Huge number, with a stated target to exceed $10 trillion. And wealth management specifically had an excellent quarter, didn't it?
Absolutely. Wealth management achieved a record pre-tax profit of $2.2 billion. Impressive margins, too, exceeding 28%.
Wow.
But the real insight here, I think, is their strong net new assets. $59 billion, even absorbing a $22 billion headwind from seasonal tax payments. Right, tax season impact.
Exactly. So this isn't just market appreciation. It's really a testament to the durable value of advice they provide. You see it in the record fee-based flows, $43 billion. That clearly shows clients are actively seeking and, importantly, willing to pay for sophisticated guidance in this complex environment. Their fee-based assets now stand at $2.5 trillion, which points to very sticky, recurring revenue streams.
An excellent quarter indeed for wealth management. But beyond those headline numbers, what's unique about their approach that's driving this asset growth? Is it their tech, their advisors, or something else? What's the engine?
Well, it's truly broad-based, which is always a strong sign. The growth is coming from all three of their client channels, the traditional advisor-led, their workplace solutions, and also self-directed.
Okay.
What's particularly noteworthy, though, is the strong inflows originated from the workplace channel. They said 70% of those flows were net new assets to the firm.
Oh, interesting. Yeah. So it means their investments in capabilities like E-Trade and that essential workplace channel aren't just retaining clients, they're actively serving as powerful engines for future growth. It's like a direct pipeline for new client relationships.
That's a clear path to future growth then.
Yeah.
Now, on the lending side within both management, are they tightening standards or are they still comfortable expanding credit there? What's the strategic play?
That's a critical strategic lever for them. We saw bank lending balances increase sequentially to $169 billion.
Okay.
And it was predominantly driven by securities-based lending. So this isn't just broad-based lending. It signals a more targeted approach. They're deepening relationships with existing clients by offering comprehensive portfolio solutions, often collateralized by the client's own investment.
Right, using the assets they already manage.
Precisely. Total deposits also increased to $383 billion. And their net interest income, NII, remained flat sequentially at $1.9 billion. That indicates continued stability in sweep balances those funds that automatically move into interest-bearing accounts. They expect NII to remain around these current levels, subject to any policy rate changes from the central banks.
We've seen how effectively they're growing client assets in wealth management. I'm genuinely curious, does that same strength extend to their broader institutional investment management arm, or are the dynamics different there?
Yeah, absolutely. We see similar strength, just on perhaps a different scale. The investment management business delivered strong results. Revenues of $1.6 billion, that's up 12% year over year.
Solid growth.
Very solid. Total assets under management reached a record $1.7 trillion. And crucially, they generated positive long-term net flows of $11 billion for the quarter. That brings the year-to-date inflows to $16 billion. So this organic growth isn't just the market lifting them, it's a direct product of them leveraging their global distribution capabilities, particularly strong in fixed income, and meeting that strong demand for what they call parametric customized portfolios.
Parametric customized portfolios.
Yeah.
Like tailored solutions.
Exactly. Tailored investment solutions built to meet very specific client objectives.
That makes sense. Tailored solutions for specific needs. Okay, shifting gears to the Institutional Securities Group, ISG. Revenues there were $7.6 billion, supported by their equity and fixed income markets franchises, with notable strength mentioned in Asia and EMEA.
Yeah, it's important to note, though, that the underlying business performance within ISG, it varied quite a bit through the quarter. Investment banking activity saw a noticeable pause in April and the first half of May. Often happens amidst market uncertainty.
Right.
However, it recovered strongly in June. This rebound, particularly in IPO performance, really supported broader corporate confidence, especially as new market windows for public offerings began to reopen.
So a tale of two halves for investment banking as well then.
Yeah.
What were the specifics on how that division performed?
Investment banking revenues overall were $1.5 billion. Now, while they saw some year-over-year declines in debt underwriting and advisory revenues were $58 million. Reflecting lower completed deal activity. Equity underwriting gained significant momentum. Equity underwriting revenues hit $500 million, improving meaningfully. That was driven by broad-based strength in convertibles, follow-on offerings, and crucially, IPO issuance that really accelerated towards the quarter's end as those market windows opened up again.
And what does that signal for the M&A pipeline? Is the backlog building, or are deals still sort of stalled?
No, the M&A backlog continues to build across regions, which is a great sign for future activity. There's a thematic focus, they noted, on growth companies, particularly in healthcare and technology. That aligns with some big long-term trends.
Right.
The IPO pipeline is also looking balanced between the Americas and Asia, sort of poised to launch as broader market conditions become even more favorable. It's definitely a story of, I'd say, anticipation and maybe some pent-up demand.
Beyond the strategic deals and the M&A pipeline, how did their core trading desks perform during this, somewhat volatile quarter? Was it a consistent story across equities and fixed income?
Well, their equities franchise delivered pretty robust results. Revenues of $3.7 billion, reflecting growth across products and regions.
Right.
Impressively, prime brokerage revenues hit a record that was driven by all-time high average client balances. That's a direct benefit of their integrated model, right? Attracting more sophisticated trading clients.
Yeah.
Fixed income revenues were $2.2 billion. That was primarily driven by strength in macro products, things like interest rates and foreign exchange, benefiting from client hedging activities, trending FX markets, and those shifting interest rate expectations we saw.
It sounds like their trading teams were pretty adept at navigating the volatility then. What about their lending provisions within ISG? Any notable impacts there? Were they building reserves?
ISG lending provisions were $168 million. They said that was driven by a combination of portfolio growth and also a moderately weaker macroeconomic outlook that they're factoring in.
Okay.
It's worth noting, though, net charge-offs were relatively low at $19 million, and those were primarily related to commercial real estate loans that were largely provisioned for, accounted for in prior quarters.
Yeah, so legacy stuff mostly.
Seems like it. So it indicates a disciplined approach to managing that credit risk.
So the ISG side had its challenges, but seems to be managing risk effectively. And speaking of effective management, how are they controlling their overall costs and improving efficiency, especially with these higher volumes we've seen? That must put pressure on costs.
That's a great point, and they did address it. The firm reported a year-to-date efficiency ratio of 70%. That reflects gains from disciplined spending, leveraging technology more effectively, and increased productivity across the board.
So getting more efficient.
Right. And this improved efficiency comes despite those higher execution-related costs from the elevated volumes, meaning, yeah, they're doing more business, which costs more in itself, but they're still finding ways to be more productive overall. They also commented on the potential for a more constructive regulatory backdrop, specifically mentioning the new SLR proposal, that's the supplemental leverage ratio, impacting bank capital.
Right, the capital rules.
Right. Yeah. And potential CCAR reform, which could streamline overall capital requirements. This suggests maybe a reevaluation of the total capital framework might be on the horizon, could potentially free up more capital for growth down the line.
That's significant for their future flexibility, certainly. There was also a question during the call about stable coins and tokenization. How are they approaching those rapidly evolving technologies?
Yeah, they acknowledged active discussions and careful monitoring of the landscape. They noted it's still, quote, early to tell the specific impact on their businesses.
Understandable.
But they remain very close to all technological advancements in the space. It's clear they're staying informed, but perhaps without committing too early, which seems like a prudent stance in such a new and evolving area.
This call really painted a picture of a firm strategically positioned for a shifting market, didn't it? What stands out to you regarding the broader market backdrop and management's response to it all?
What's truly fascinating here, I thought, was management's observation that boardrooms seem more accepting of ongoing uncertainty now.
Interesting. Less paralysis.
Exactly. Despite that initial trade policy volatility we saw earlier in the quarter, they saw a pickup in strategic activity and robust interest from both corporates and financial sponsors on the buy side. Their view seems to be, if the cadence of tariff policy or, any other geopolitical friction remains within broadly expected and sort of quantifiable parameter.
Manageable uncertainty.
Manageable uncertainty, right. Then they anticipate a strong second half of 2025 and into 2026. That signals a real shift from paralysis to a more proactive approach, which is, crucial for deal activity.
It sounds like the market is learning to live with some level of uncertainty, which is a powerful insight. They also discussed the concept of the integrated firm quite a bit. Can you unpack why this is such a critical competitive advantage for them? What does that really mean in practice?
Yeah, think of their integrated firm strategy like a well-oiled machine where every part of the business, from investment banking to wealth management, is designed to feed into and strengthen the others.
Synergies.
Real synergies, exactly. They highlighted their ability to run global businesses, pointing to those record quarters in European and Asian equities, and that consistent, $2 billion quarterly performance in fixed income. The integrated firm isn't just about cross-selling, it's about knitting clients across their global platform for capital, for ideas, financing, strategy, driven by a top-down culture that really benefits the entire franchise. This holistic approach is absolutely critical for generating that operating leverage and delivering those durable returns we talked about earlier.
That makes perfect sense. True synergy between divisions, not just on paper. And on the lending front, there was some discussion about the trend of banks lending more through their capital markets divisions. How does that connect to the bigger picture for firms like this one?
Yeah, this connects directly to that bigger picture of potential regulatory normalization and just market evolution, really.
Mhm.
They believe the largest, most sophisticated, and crucially well-capitalized global investment banks, particularly those with strong wealth and investment management businesses alongside, are really poised to regain core share in corporate products,
Okay.
especially in the mid-cap space and in complex event financing, where their balance sheet strength and those integrated capabilities offer a distinct advantage. It suggests a potential shift back towards the big banks in areas where they might have previously been a bit constrained by regulations post-financial crisis, could make them even more dominant players going forward.
Okay, it's time for our This Is Not Financial Advice segment, where we stretch the limits of plausibility for a trade idea. Considering everything we've just unpacked, the capital flexibility, the strategic growth, that integrated firm model, and the improving regulatory outlook, what's a wild yet maybe plausible trade idea that gets you thinking?
All right, this one's definitely for the bold, maybe the brave, but it's rooted in some of these deep trends we've discussed. Given the firm's significant capital flexibility, remember that CET1 ratio is 200 basis points above requirements.
Right, that cushion.
That big cushion. And their aggressive organic growth strategy, especially in areas like wealth management and that anticipated investment banking recovery. Here's a thought. Buy a large chunk of their shares, okay? And concurrently, maybe sell some deep out-of-the-money puts to potentially lower your cost basis or generate income.
Okay, buying shares, selling puts. Standard enough so far.
Here's the outrageous part.
Yeah.
You're betting on an acceleration of M&A and IPO activity in Q3 and Q4 that doesn't just meet, but blows analyst estimates out of the water.
Ah, okay, the big upside surprise.
Exactly. And not just because market windows are open, but because this specific firm is going to capture a disproportionate share of that activity due to its integrated firm model and that renewed regulatory flexibility for lending we just talked about.
Right, leveraging their specific strengths.
Precisely. The consistent dividend and the share buybacks provide a kind of fundamental floor, so your downside is perhaps somewhat cushioned. But the real alpha, the surprising upside, comes from an unexpected surge in those high-margin banking fees, driven by those regulatory tailwinds and the cross-platform synergy that, frankly, many generalist analysts simply aren't modeling as aggressively yet. It's a double-down, strategic execution meeting a potential regulatory reset.
So, to recap then, a strong second quarter for the firm, driven by impressive performance across both wealth and investment management and institutional securities. Their integrated strategy seems to be clearly working, enabling them to navigate these complex market conditions and capture significant client assets and activity.
And if we connect this to the bigger picture, the firm is definitely entering the third quarter with some clear momentum. They've got healthy investment banking pipelines that seem ready to go and markets that appear more resilient, more accepting of that uncertainty we mentioned. Their focus on strategic capital deployment and that continuous investment across their core businesses really positions them, I think, for sustained, durable growth, even in what's likely to remain a dynamic environment.
We hope this deep dive gave you some valuable insights and maybe prompted some new thoughts for your own analysis. And remember, the information presented here is strictly for informational purposes only and is absolutely not financial advice.
Yeah, definitely encourage you to continue your own research and due diligence. As you look at the market, maybe consider this. How might this concept of an integrated firm fundamentally shift market share dynamics in the financial industry over the next few years? We're curious to hear your take.